Ladies and gentlemen, welcome back to the channel. Here in this video, we are going to get into a price prediction for AMC stock this week, but I want to take it a little bit further than that. In the last video, we kind of gave you a rough overview of what we have in store for earnings for the Fed as far as timing and what potentially could happen. Went into a little bit more detail on the Fed, but I want to get into everything here in this video, what my expectations are for certain stocks earnings, for the economic data that comes out, and for the Fed. Now, I'm subject to be wrong. I'm not a financial advisor. I'm definitely not a fortune teller, and I most certainly do not have a crystal ball, so do not trade based on anything that is said here in this video. But I think it's not too difficult to see what could transpire next. Now, could is definitely the key word here, because you ultimately never know. And this is going to be a big week for AMC stock. It's going to be a make it or break it week, if you will. If we get any news on AMC, that obviously changes the situation, changes the equation a little bit. There's always a chance that Adam Aaron, dilute shareholders again, or says, hey, we're not going to dilute shareholders for a period of time. One of those is very good. One of those is very bad. That news will come probably when it's least expected, because again, mathematically, that has to happen. They have to be able to get AMC stock higher, or they will never be able to pay off their debt. And where we're at right now is nobody wants to own AMC. I think that's to some degree a positive for anyone that is buying AMC stock at $4 per share, because it appears as if your risk to reward is very much positive right now, right? Because, I mean, AMC is trading lower than even your most bearish analyst price targets. A lot of that has to do with dilution. A lot of that has to do with a weaker movie slate right now. But, just judging off of AMC stock being literally oversold on the RSI since the start of 2024, really, I mean, what day did we go oversold? January 3rd, literally, 2 days into 2024, you went oversold in the RSI, and you have proceeded to fall roughly about 33% to start the year. I mean, you're set up in a pretty optimal position where expectations are very low. Any good news could be really good news for AMC. So keep that in mind, as well as any good news for the broader markets. The path for interest rates, the path for the economy will also be great news for AMC. Or, well, there's a problem on our hands, because stocks on Friday hit yet again a new all-time high. You're kind of just melting up at this point. You're not gapping up at this point. You're just kind of going higher systematically. Any bad news here might catch the markets way off guard. So let's go ahead and focus on that first things first. Let's run through kind of the economic data, because I think this is going to be the easiest. So on the calendar here, you have some manufacturing indexes from the Fed. All of those will be important, and they're kind of scattered throughout this week. So just pull this up for yourselves. Keep it on your phone or your computer. tradingeconomics.com/calendar. Very easy to find. It's free 99. It costs you nothing. I'm not paid by them or anything, but this is literally what I've used for years. And it's just a very easy tool. I like to have it on dark mode, but you guys, if you prefer it on light mode, you can also do that for yourselves. Now, the JOLTS job openings will be the first major catalyst data point coming Tuesday. That will be at 10 o'clock in the morning. You're expecting less job openings, from 8.79 million last month to 8.69 million this month. I'll tell you right now, If job openings come in lighter than that, that's okay. Anything under like 8.5 million, though, is going to be seen as very bad news, because, I mean, if people are taking away their job openings, likely their businesses are not doing that well. Now, for Wednesday, mostly just going to be the Fed. We really don't have any other data that will be important there. For Thursday, we are going to get the ISM manufacturing PMI for January, expecting that to actually get a little bit better here. I think you're kind of set up for disappointment there, considering all of the other manufacturing data that we have seen over the past couple of weeks has been really negative. So I think that could also come in weaker than expected. I mean, it's been weak for a long time. Now, Friday is going to be your big day as far as economic data is concerned. Manufacturing, all of that is one thing, but the non-farm payroll report that comes out on Friday is the most important data to the markets. The second most important data to the markets is inflation, but I mean, if the labor market starts to crumble, if it looks like we're heading into a recession, that's going to be more impactful to stocks, believe that or not, in a negative way, perhaps compared to inflation spiking, right? We actually technically seen inflation go up on a month-over-month basis. Last month, stocks continued to hit all-time highs, basically every single day now. Well, non-farm payrolls are expected 178,000. You really want to watch the revisions here because a lot of the time you've seen some massive revisions. So if that happens to last month's data, 216,000 job ads, maybe you get revised to 160, 170,000. Markets may start to look at revisions and say our labor market is not as strong as we think it is. You're expecting 178,000 job ads. Maybe you come in at about 150,000 job ads. That would be around my expectation for January. Typically, there's a lot of seasonal hiring like November and December and some seasonal layoffs, if you will, for January. So I'm not in the camp that we're going to have a super strong labor report. If you do, though, I mean, that's probably going to be good news, I would imagine. The unemployment rate is expected to tick up from 3.7% to 3.8%. I think that would be okay. Anything, higher than 4%, markets start to panic. Anything less than that is, good news overall. So those are my expectations a little bit for the economic data. Just not super excited about it, but there is a chance. We've seen non-farm payrolls continue to beat to the upside, at least the initial report, but then the revisions are like huge. So markets haven't cared about revisions so far. But if you actually look at the revisions, the labor market has not been nearly as strong as the initial number appears when we do get it. Now, people say it's seasonal adjustments, blah, blah, blah. But yeah, still, point is, it hasn't been as strong as we would think. Now, for the Fed's going to be on Wednesday. The Fed's going to be one of the bigger catalysts for this week, the bigger events that we will have. And essentially, the Fed is kind of going to outline what's coming next. Now, I believe the Fed is going to outline an end to quantitative tightening coming by the March meeting. So that will likely have the effect of uninverting the yield curve, because the Fed on January 24th, just 4 days ago, came out and said they're done with the bank term funding program. Now, the bank term funding program is literally being utilized at an all-time high right now. $167 billion. It just keeps going higher. Basically, every single day, it just goes higher and higher and higher and higher. This is essentially a fund used to bail out the banks in terms of bonds. So if banks are underwater on their bonds, they can give their bonds to the Fed and get par value back for the purchase price that they bought the bonds for. The Fed will hold them to maturity. In the meantime, the banks get their money back to fund their operations. Now, why would the Fed end this program when almost $168 billion are currently being utilized in this program? Well, it's because, they're not just going to take this money back, they're not going to recall this money back from the banks, but they're going to stop giving new loans here coming on March 11th. Now, that's interesting timing, because if the Fed were to announce an end to quantitative tightening, the bond market would rapidly readjust pretty dang, shortly thereafter what could be on Wednesday, because investors are going to say, hey, if the Fed's no longer selling these assets, we should start buying them because rates are going to go a lot lower, and that's going to take the burden off of banks. So coming by March 20th, there could be a lot less of a burden on banks. Basically, 10-year treasuries, 2-year treasuries, all of the yield curve could fall. Their yields could go down. Thus, bond prices could go higher. Investors may start to buy the bonds. And that helps out the face value of the bonds. That helps out the banking industry. So that's a big thing that I'm expecting for this week. And I do think that will positively, cause yields to fall. And I think that will cause investors to get somewhat bullish. I don't know if the markets might take that as bad news, maybe something's wrong, the Fed's going to have to be careful actually communicating that. Now, as well as that, I'm expecting the Fed to kind of push back on the March rate cut. If they more or less confirm the rate cut, then that might be some good news, because you're no longer expecting the rate cut coming March 20th. But for full year 2024, I expect the Fed's going to still stay firm with, we're going to be data dependent. They're not going to provide a lot of clarity on the forward looking situation. So they're going to leave a lot of it up for markets to interpret. Even Goldman Sachs, like I said in the last video, came out and says they now expect the Fed will deliver 5 rate cuts in 2024, which is almost priced into the markets. There's only a little disparity here, about 0.8% between 5 rate cuts and 6 rate cuts. Currently 6 rate cuts are expected. So overall from the Fed, I'm expecting it could be more positive than not, but there is always that chance that, it's not going to be. And if anyone tells you they know, what the Fed is going to do, they're obviously lying to you, because nobody knows, what the Fed is ultimately going to do. So it's just keep that in mind. You never really know. Now, earnings are going to be a big story as well this week, and I think earnings so far have not been so great. Earnings have been very underwhelming from some of the companies that we have heard report, even like a Visa, right? Credit card companies. None of these earnings have been truly great. And this week, you're going to have your big tech, Microsoft, Google, Apple, Amazon, basically all of your big names besides Nvidia. Nvidia will be later on. You're also going to have other sectors like GM, UPS. UPS is actually a vitally important company, because they will give us a glimpse of how maybe the consumer is doing. If their business is doing well, then people are still spending lots of money, and that's good for economic activity. Now, Monday is going to be all about the small cap stocks. I think Monday could be a big day for AMC as well. SoFi pre-market tomorrow, and then you will have Supermicro, the largest component of the Russell 2000, that will be reporting earnings Monday in after hours. So Monday's a big day as far as small cap stocks. The rest of the week is going to be about your big tech. And then think about it like this: Wednesday you have the Fed sprinkled in right with your big tech earnings. So it's definitely going to be a volatile week. I just think the expectations are a little on the high side for earnings overall. You're expecting around 11% EPS growth for the S&P 500. Any weakness there, any weakness in full year guidance is not going to be good. So ultimately, I do think this week could be slightly negative due to potentially some bad earnings from some of your big tech names, and or Supermicro and AMD really taking some of the air out of this semiconductor kind of bubble, if you will, that we are seeing right now. Supermicro is up 70% in January alone. AMD's up 26% in January alone. Nvidia's up 27% alone in January. Could you see a correction there? Of course. Could that start this week? I think most likely, and I think that could really just have a huge impact overall on our market. So I'm expecting some good, some bad. I think the Fed's going to be more good than bad. I think the economic data could be a little bit more neutral, and I think earnings are going to be on the bad side. Take it for what you will, what you think that ultimately means for the markets. Now, my personal opinion is AMC stock, small cap stocks are more so probably going to react to Fed policy and what happens with interest rates. I think your broader markets, your S&P, your NASDAQ, are going to react more to earnings, because let's be honest, when the Fed cuts rates, it doesn't really affect the S&P 500 all too much, right? Earnings are not going to improve that much when the Fed cuts rates, but it will affect small and mid-cap stocks a lot more. So I think small and mid-cap stocks, again, are going to react more to Fed policy. I think broader markets are going to react more to earnings. With that being said, I am expecting somewhat of a bullish Fed Jerome Powell. I do think AMC stock could probably rally close to about that $5 range. That would be a return of about 25% or so from here. That seems logical to me coming this week, and I would not be surprised if that were to happen. Now, to the contrary, if earnings are bad, if the Fed is bad, if the data is bad, then AMC stock could fall probably to about $3.30 or so per share. That would be a loss of about 20% from here. So I'm expecting a huge move coming this week nonetheless. So that is going to do it for this video. Hit that like button and subscribe to the channel. Let me know what you think about this information down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.